Hi, everybody. Let's look at, we're continuing looking at depreciation, and we're going to look at depreciating an asset using the double declining balance method. Sometimes the textbooks say declining balance method, but it's really the double declining balance method because we're going to see it's at double the straight line rate. Okay, looking at the example that we've done before, we did the straight line depreciation on this same numbers. We've got a piece of equipment cost us $12,700. We've estimated salvage at $2,700. The difference between the two is our depreciable basis. Okay, we are going to depreciate this asset. It cost us $12,700. We're going to depreciate it $10,000 over the next 5 years to give us an ending salvage value of $2,700. Now, the question is, what method are we going to use? But regardless of the method that we use, we're still going to depreciate it $10,000. So we need to know the cost, the estimated useful life. In this case, it's 5 years. We're using the double declining balance method. And we know that whatever amount that we get per year, we're going to debit depreciation expense and credit accumulated depreciation for the amount that's the depreciation expense that year. Okay, let's look at the formula for the annual depreciation expense. We take the straight line rate and then double it. Okay, so to get the straight line rate, we see that we get 100%, just use 100% divided by its estimated useful life, and that's 5 years. So we're going to take 100% divided by 5 years, and we see in our case 100% divided by 5 years is 20% per year, and then we're going to double it. So our annual depreciation rate is going to be 40% per year. Okay, straight line rate, which is 100% divided by the estimated useful life, 100% divided by 5 years, 20%. Okay, if we were doing the straight line rate, it would be 20% per year. But we're using an accelerated depreciation, double. So we're going to double it to 40% per year. You say, well, how do we can't take 40% per year? Well, you don't do it times the total amount. You do it times your undepreciated amount or the net book value. So let's take a look, shall we? Okay. When you start this calculation, ignore the salvage. We'll get back to that in a second, but ignore the salvage in your calculation because guess what? We're always going to have something left over. If we take 40% of something, 60% of it's always going to be left over, you know. So we'll always have something left. So year one, let's take our cost of $12,700, use our rate, and that's $5,080, which is going to be our annual depreciation expense that we put in the first year in the journal entry for the first year. Okay. At the end of the first year, what is the asset going to look like? It's going to be what? 12,700 minus 5,080 gives us a net book value at year end $7,620. Okay, hey, that's a chunk in it because remember, straight line depreciation, it was $2,000 per year. And here this first year, we took $5,080 depreciation expense. You know, that's a much larger depreciation expense. So we see how we're in an accelerated depreciation, we're front loading the depreciation expense and writing our asset off quicker than using straight line. Okay, so when we get to year two, what do? We don't start with the 12,700 again. We start with the net book value at the end of the first year becomes the net book value at the beginning of the second year. And what do? Take 40% of it, and we get $3,048. So when we do our calculations, Okay, at the end of the second year, the 7620 minus another 3,048, we add those together and get what, 8,128 total and accumulated depreciation, gives us a net book value of 4,572 at the end of the second year. What do we do at the third year? Take that book value at the end of the second year, take 40%. We get $1,829. Do the same thing. Okay, here's the kicker. As we get toward the end of the life, hey, we've taken a bite out of it, hadn't we? We've used these large depreciation expenses, and so we've already said that our depreciable basis, the total that we're going to depreciate, the asset is only $10,000. We get down here to year 4, and you've depreciated it almost down to where you want it to be. You've only got what, $43 left. So that's your depreciation expense for year 4 and nothing for year 5. Gang, this is assuming I did the calculations correctly. So I hope so. And so we see that we still get $10,000 depreciation out of this machine, but we sure have used this accelerated method to depreciate the asset a whole lot quicker than we would have under straight line depreciation. So we can see how uh, uh, people like it because they can write things off, more quickly than under straight line. So let's review the calculation one more time, shall we, for the annual depreciation expense. What do we got to have? We've got to have the useful life. So you take 100% divided by the useful life. You get that percentage, double it, and that's what you're going to use. Use that double rate, double declining rate, times your undepreciated amount that you've got on that asset, which is the net book value. And then you're going to take that, and every year you're going to take 40% of it till you get to the total depreciation expense that you're going to take for this asset. So I hope this helps you see double declining balance depreciation. Like I said, it's an accelerated method, and with an accelerated method, we're taking depreciation faster than we would under the straight line rate where it's the same every year. So that's the double declining balance method. I hope this helps. See you next time.